I am excited about this call and really looking forward to it, and hoping that many people get what they need to begin to take this step. I have tried talking people into it so many times throughout the years, and it's amazing at how few people do it, but I get it. I've been next month, and I'll say this again, but next month we're going to have somebody on doing a presentation for infinite banking.
Okay.
And that's something that I've known about for years and never moved forward, never pulled the trigger. I sort of, being the real estate investor guy, just had a hard time with that, making that jump and making that move. But the reality of the situation, there's times I wish I would have made that move a long time ago, and I would have done it. And working it the right way could have just never affected my real estate business at all. It could have just done nothing but enhance it. And so I'm looking forward to that discussion next month as well.
Yeah, we'll tune in. I'd be interested in hearing more about that as well. Especially as we're looking to do some things with life insurance anyway. I think that's another natural step to that.
Well, I'll get more and more clarity about it. All right, we're going to start seeing lots more people chiming in here in the next few minutes. So we're going to give it another 2 or 3 minutes just to let people get in.
Okay.
And then we will get started.
Okay.
I'm real quickly, is your banker going to join us?
He is not.
Okay.
Stay here on call. You can call back later.
Welcome, everyone. I'm seeing a lot of names I'm familiar with, and I'm seeing some that I'm not. And unfortunately, I'm only getting to see names. I'm not getting to see faces because everybody's hiding. Hey, Jonathan. Got Hussein. Been a while. How are you, Hussein?
Oh, pretty good, Steve. It's been a while since I've talked to Sini. Yeah, hopefully you're doing good.
I am doing well. Hope you're doing the same.
Yeah, thanks for asking.
Are you in, I know you made the move to Madison. Are you still working in Baraboo?
Yes, yep, I'm here a couple days a week, but yes, I did move down to Madison, so it's been nice sort of slowing down.
We'll have Lifeonaire in your neck of the woods. Actually, we had to move it to Milwaukee, but we'll be in Milwaukee at the end of the month.
Oh yeah, I did see that. I'm excited about that one. So I think it's on the 30th, if I remember correctly.
Yes.
Actually, I think it starts on the 29th, 30th, and October 1st.
Well, Jason is here. Maybe he
30th, 1st, and 2nd, Thursday, Friday, Saturday.
Okay. I had the wrong month up.
All right. Well, we are filling up here. It is 12:01. I'm going to go ahead and kick us off here, get us started. So I want to just take the time to welcome everyone. This is our monthly Global Connect call, and this is a call where we are just, want to bring great content to you. We want to bring good discussion. We want to bring just some things that have really helped people to live and experience a Lifeonaire lifestyle. And today I am very excited about what we're going to be talking about. We have Laura Halverson and her husband Steve are with us to share with us this concept called velocity banking. And I have been employing this at some degree or another for many, many years right now. It is one of the things that I use to help eliminate my debt, to help shore up my entire financial foundation and just to really get some things into place that really accelerated wealth building and building cash flow for me and in my life. And I have never taught about it formally. I've never put together a presentation. I have sat down with many of my students, one-on-one, and made the suggestions on, hey, here's how you should do this. But I have never taken it out to the public in general. And so I'm really excited that Steve and Laura have sort of put together something that they're going to be able to share with us and to give it a little more meat, and instead of the way that I have been sharing it throughout the years. But here is one of the challenges, and we're going to hope to overcome this for all of you as well here today. I have taught this to many people. I've spoken to them about it, and I have encouraged them to do it. And so often they come back to me and they say, Steve, I've looked around and nobody will do it. I've talked to my banker and my banker won't do it. And I got to tell you, that is just such a foreign concept to me, because every time I do it, I just walk in and I get what I'm looking for. And I think it's because I know what to ask for. I think it's because I know how to speak the banker's language, and how to get them to that point. And Laura is going to touch upon some of that today too. She was actually hoping to have her banker here, but she can tell you exactly what the interactions were with her banker and how she got her banker to listen to her and to actually create this for them. And it is a lot easier than what you would think, and it will be very, very beneficial. So I want to take some time to just welcome Steve and Laura. Steve and Laura, thanks for being with us today and willing to share.
Yes,
Thanks for having
thank
us.
you for having us.
Now, I think that I need to qualify, and Steve probably won't disagree with me, that Laura is the one, she's the brains behind this.
Yes,
And
she is. This is educational day for me.
so Laura is the one who put this together. She's the one who made this happen. And we're going to be turning it over to her here in just a moment so that she can go ahead and start sharing with us. I'm going to actually change my view here a little bit, but before we get started, I just want to also put in a plug real quickly for our upcoming Lifeonaire Summit. Those of you who are in a titanium group are already going to be in Atlanta having your retreat with your group. And we're going to have that one add-on day for the Lifeonaire Summit where we bring everybody together. But even if you are not in one of our coaching groups, you can join us for that day and be there for the Lifeonaire Summit. We want to encourage you to be there and to just come alongside of all of us, join us, rub shoulders with us. It's going to be a great day of education, a great day of networking, and we hope to see you there. So Laura, I'm going to go ahead and turn it over to you.
Okay, terrific. I think I'd just like to introduce Steve and I to the group because there's a lot of names I don't recognize. Just to give you a little bit of background, Steve and I discovered Lifeonaire in 2016. Jason came to a RIA event that we had in the Appleton, Wisconsin area, and we soon attended a 3-day Get a Life event. And at that time, I think the best way to describe us is we were a hot mess. I think part of the reason this velocity banking became so important to us is because we had a lot of experience with debt. We came into Lifeonaire with nearly $5 million worth of debt. It was actually $4,893,104.06 worth of debt. I had to go to work every day because we had negative cash flow in our business. And we've done a lot of things throughout the last 5 years to improve our financial situation. I'm happy to report that we've paid down 51% of our debt that was associated with our real estate business. And today our real estate debt on our rental properties is only $2,496,475.07. Only. So we paid off 51%. So I think I am pretty much an expert in dealing with debt. And I've looked for lots of strategies to help us reduce our debt. So I'll just share the one on velocity banking with you today. And okay.
Is that on the screen for everybody?
Can everybody see my velocity banking?
Yep.
Okay. Whoa. We don't want that happening. I apologize. That's a little bit faster than I can present. Okay. So just a little bit of background on what is velocity banking. Velocity banking is a debt reduction strategy used to pay down liabilities as quickly as possible without having to increase your income or drastically change your lifestyle. Some of the models that I've seen on the internet, there are tons of articles on velocity banking out there, but some of the models show that you have potential to pay down your debt in as little as 5 to 7 years. The concept is called velocity banking because it can help you to increase the velocity or the speed of your debt pay down. And I think I just want to talk a little bit about what traditional banking looks like. We've all likely been taught the same way to do our banking. We open up a checking account, you deposit your paycheck into the checking account, you pay your bills from your checking account, and you hope at the end of the month you have money left over to put into your savings account. Now I just want to talk a little bit about how velocity banking works. So the thought process is you use your home equity line of credit as your expense account instead of using your checking account. And then when you get your paycheck, you're actually making a payment on your home equity line of credit, therefore reducing the balance. To pay your bills, you get an advance on the HELOC. And you really don't need to have a savings account because all of the extra money that you save every month is driving down the balance of your home equity line of credit. So Steve talked a little bit about going out and getting all of these types of accounts. I spent a lot of time researching velocity banking, and I approached all of the bankers in our area to come to find out none of them offered any sort of product like this. So what I was able to do is have a conversation with a lender that we use. And I think it's important to establish great relationships with your lenders. They are on your team. And I actually educated him on what velocity banking was. So we came up with our own variation of velocity banking, and they literally built this on their system to accommodate us. They have since attended our local RIA to share this information with other real estate investors, and I'll explain to you how our process works. So we have a checking account, and I'm going to put a plug in for them. They happen to be Unison Credit Union in the Appleton, Wisconsin area. And what they did is they gave us a line of credit. Our line of credit was actually created by taking 3 of the rental properties that we had that didn't currently have a mortgage on them, and we put on a line of credit. Then what happens is as we get all of our rents coming in every month, it gets deposited into this checking account, and they set up an automatic sweep for us at the end of the night. If we have funds in our account in excess of $1,500, they'll automatically sweep it to our line of credit. And then when I'm paying bills, checks are coming in or ACH withdrawals are coming in, they'll go ahead and any monies that I'm short, like if I only have $1,500 in my checking account, they'll perform a transfer from the line of credit, basically giving me an advance into the checking account so that I always maintain that $1,500 minimum balance. If I have a lot of excess funds, my home equity line of credit may be actually sitting at a zero balance while I have money sitting in my checking account. But the real advantage of doing this is I don't have to remember to transfer the money every day if I know I'm writing out checks or I have withdrawals coming out that are in excess of the balance of my account. And because I only have to maintain a $1,500 balance in my checking account, anything above and beyond that, they are sweeping into the line of credit to make a payment, therefore reducing my balance that I have on my line of credit, and consequently I'm paying interest on. So it's like the most efficient way for me to use our equity in the property.
So Laura, just so we don't lose anybody, I just want to sort of restate some of the things that you have said. So just make sure we have everybody before we keep moving forward. So what Laura has been able to get the bank to agree to is a pretty sophisticated system. I never had the sophistication in place where the bank set everything up to automatically do the sweeps and everything for me and to move the money. I had to manage that part of the process of it myself. And so I don't want you, if you can get your bank to set this up, this is awesome. If you can't get the bank to put this in place, don't feel like you can't do this. You can still do this, but you may have to manually manage to moving the money back and forward yourself if the bank doesn't put these other things into place. I have always manually managed the moving of the money myself and still do to this day. I put a line of credit on every one of my rental properties, and I might use that to buy another property. I might use it to lend to somebody, but we use this exact strategy to pay that down and to eliminate the debt as quickly as possible, just not necessarily the sophistication that the bank is providing here.
So Steve, have you not been able to get a lender to do it automatically? Is that why or do you choose to do it manually, or is it just because they still haven't offered?
I've never asked them. So, I mean, so this is new to me to have it set up to where the bank does that. I have always just gone on and gotten a line of credit and manually managed all of that myself. Whenever there was excess cash in the checking account, we just put it right down on the line of credit. And then if we needed to draw against the line of credit, we just moved the money off the line of credit over into the checking account so that we could pay bills. But it was always a manual process and has been a manual process for me.
Mm-hmm. I really appreciate the sweep. That way, if things are clearing and I'm not managing my checking account every day, I know everything will be cleared automatically and I won't have to worry about anything potentially being returned. Something I just would also like to add about, well, I'm probably getting ahead of myself. I think I have a slide on that. Should I continue?
Sure, yep.
Here we go. Benefits of velocity banking. And that's one of the things that I'd like to talk about, of the things that it is, how it's benefited our life. We've been able to rapidly decrease our debt. We've increased our monthly cash flow. Our particular line of credit that we have only requires interest only. So we can always pay extra if we have extra cash coming in. But if we don't have extra cash, we're only responsible for an interest only payment on our line of credit. In our business, we invest a lot in real estate. And one of the things that's a good example of what we use our account for is, as our rents are coming in every month, instead of setting aside like 1/12 of it for our property taxes and our homeowners insurance and sitting in a savings account earning little to nothing, we're actually putting that money against our line of credit when we have a balance. So we're paying less interest overall. It also increases our cash availability because we have this line of credit that we can draw on when we need to, instead of a standard mortgage on the loan. When you go and you pay it down, you may have equity sitting there that you can't really do anything with. By putting a line of credit on it, you've got the cash availability if you need it. It also helps to create some financial independence when maybe we're looking to purchase another property or do a rehab. Instead of having to go to our lender to request a loan for those purposes, we have the equity in these properties that we can draw upon to make those investments either in another home or to finish a rehab project that Steve's working on. And what I was talking about before is velocity banking has really helped to reduce my stress. I used to, back in 2016, when we joined Lifeonaire, I used to balance our checking account every single day because I would have shortages and I would need to make sure that there were always adequate funds in there to take care of everything.
There's multiple accounts as well.
Yeah.
So
So it has reduced my stress and I think improved our relationship because I have less stress.
this is a true statement.
Some questions to ask when you are going to talk to your lender about putting this in place. What sort of closing costs might you incur? Are there processing, underwriting fees, application fees, appraisal fees, flood certifications, recording fees, escrow and title fees? You also want to understand lots of times different banks will come out with what I prefer to call teaser rates versus introductory rates that, you know, they might come out with a really nice low rate up front, but find out if it's just an introductory rate. And if so, what's the period that that introductory rate will last for? When you're doing a line of credit, they are typically tied to some sort of index. The index on our line of credit happens to be tied to prime rate. And you want to understand what that index is. In our case, again, it was prime, what the margin is, how much above the index or below, unlikely to find things that will be below an index. And then what sort of floors, meaning the lowest rate you're going to see on your line of credit versus the ceiling, the highest rate they're going to charge you. You want to understand what's the term of the loan. Are they willing to renew it? And I guess if they're going to renew it, if there are any costs associated with doing so. What are your repayment requirements? Are you going to be responsible for principal and interest or just interest only? It also would be important if you're going to be using this line of credit to kind of handle all of your expense accounts. Do they have any transaction limitations? Is there any advance minimums or maximums in order to make an advance on your line of credit? There are definitely a lot of pros that we've experienced with velocity banking. And if you're disciplined enough with your finances, I believe this is an excellent way to accelerate your debt pay down. You can decrease your debt quicker than with other strategies if you put in the work and you stick to it. And I have to say that getting out of debt can create a new level of peace and happiness for your life. As I mentioned before, it has reduced my stress. And I think having less stress, we all know, leads to better long-term health. And you may even find a positive impact on your personal relationships. Some cons about velocity banking. I think a lot of people in general, if you have access to more credit, you may find it easier to get into debt. And obviously that's not what we're looking to do. We're looking to reduce your debt.
That was actually one of our, let's call it a problem back in the day. You know, we had great credit, and we learned that just because you can doesn't mean you should. So
just be cautious with that. And having equity can increase your purchasing. Some people are distracted by shiny objects. And if you think this could happen to you, make sure you work with a coach that can hold you accountable for the financial decisions that you're making.
So Laura, I really appreciate you pointing that out. I've been coaching people for a long time. And I mean, I know when I have students who they should not get a line of credit. and I tell them it's a hard conversation to have, but I always ask people, be honest with yourself. If you're not disciplined enough to manage it and to do well with it, don't do it, because it can get you into trouble if you don't handle it the right way. So I appreciate you bringing that up.
I agree. If you're not disciplined, it could be a slippery slope.
Mhm. So now let's just talk about some practical things. We did have a couple of questions. One person asked, is it easy to get a line of credit from that bank if you don't have a home? The whole idea, these are home equity lines of credit. One of the things, if you own your own personal home, Steve and Laura used the example of doing it with rental properties, but you can do this with your own personal house as well. You can refinance your first mortgage, if you have one on your home, with a home equity line of credit, and then use this strategy to pay down your house as quickly as you can. It doesn't work if you have a first mortgage and then you get a home equity line of credit as a second behind that. The strategy does not nearly work as well. What you want it to do is replace your first mortgage so that all the cash you have, all the little things you might put into savings, rent checks as they come in, paychecks, immediately pay down your line of credit, because every day that the balance is lower, your interest payment is lower. Every day that you can take whatever savings or cash that you would have and put it against your house is saving you money, and more of that is going toward the principal pay down of your home. And this is how you accelerate paying down your house. So for anyone who is thinking about doing it on your personal residence, the idea is to refinance your existing first mortgage with a line of credit and make that the first mortgage so that you eliminate the first mortgage. And the beauty of it today is, the interest rate might be a little bit higher, but your payment will actually drop because it's interest only in almost every instance. And the monies that you get to put against your house, like if you have a 30-year mortgage and you have an extra $50,000 laying around, if you pay that $50,000 off on your 30-year mortgage, you don't have access to that $50,000 again. You can't use it to make more money. You can't use it to do a deal. You can't use it for emergencies. It's just paid down and your payment stays the same. It didn't change. Your payment, it's just going to be less years that you're actually making payments on your home. But if you use a home equity line of credit, you can pay down that $50,000 on your house. It will reduce your interest. It'll reduce your payments. And if you ever needed that money again, or an opportunity came available for a flip or something, you could just go and pull that $50,000 right back out and put it to work in another way for you. And then the moment that deal pays off, you put it right back against the line of credit again. Hopefully, instead of 50, you're putting 60 or 70 or 80,000 against the line of credit after that deal pays off. So I just want to put that out there as a strategy for even just paying down your personal residence. And then if you're somebody who owns rental properties, as soon as you get your personal residence free and clear, you now shift to a rental property and you start to do this against the rental property. And there isn't a right or wrong answer. Where do I start? You can start with rental properties. You can start with your personal residence. It's completely up to you. But if you have no rentals or own no other property, but you do own your personal residence, you can use this strategy there. I will tell you that if you were to go talk to your accountant about it, they might say, oh, well, you may be paying a higher interest rate. That is oftentimes going to be true, that the interest rate will be higher, but the benefits and the pay down strategy isn't available when you have that 30-year mortgage in place. And again, having access to your equity. I think one of the biggest things that Laura brought up was that it reduced her stress. And when you, as I have been coaching people throughout the years who are eliminating debt, and they're making these big giant payments against their debt, they might have a large mortgage and they make a big payment against it. It feels really good in the moment, but then they're broke and then they can't get access to that money. They're house rich, but they're cash poor. And when you use this home equity line of credit, you can be house rich and still have access to your cash if you need it. And it is a huge, huge stress eliminator when you know that you can get your hands back on that cash again if you need it. So Ethan just asked a question. So does the line of credit replace your mortgage? Yes, it does. It becomes your first mortgage and it replaces your mortgage. Let's jump on a few of these questions that we have here. Jonathan asked, how often does the bank sweep your accounts? Daily, weekly, or monthly? You did say that, Laura, but
Yeah.
you-
In my situation, it's daily. So as checks are coming in throughout the day or ACH transactions that are coming throughout the day, if I only have $1,500 in my checking account, it'll sweep every time an item is presented. And then at the end of the day, if I have excess of $1,500 at the end of the day, anything above and beyond that, they'll apply to my home equity line of credit to reduce that balance. And I want to go back and reiterate the fact that my financial institution didn't know anything about this. I had actually reached out to a bunch of financial institutions that we did business with. And I think it really is important to establish a great relationship with your bank. And he was willing to take the time to actually watch some videos I shared with him about how this works. And he worked with the team at his credit union to put this in place for us. So I think if you have a good relationship, that your lender will be more likely to listen to you and help you out. And then what happened is when I got my first home equity line in place, I actually used that as kind of bargaining power when I went to another financial institution and said, this is what this institution is doing with me. If you want my business, this is what you need to do. So my primary account is with Unison Credit Union, and I also have the ability at another institution if I would ever need it for maybe some house deal comes up or a bigger project or something like that. But it's almost like once you get one in place, you can use that to educate another lender on what you did.
Mhm. Awesome. All right, so we have Fed who made a comment. He said banks can also set up lines of credit using your whole life insurance policies as collateral. And so Fed, it's interesting that you bring that up. Next month, we are going to be talking about infinite banking, and we're going to be talking about using whole life insurance and how to borrow against that and setting everything up correctly the first place, which is another strategy that I'm excited to talk about and to bring to the community. And I'll just tell you this: as I sit here, neither of these strategies, it's not like one of them will be better than the other, but I feel like when people are dealing with less money and they haven't really made a whole lot of money yet, the infinite banking strategy is a good way to get started and to really just get rolling and to get things moving. That may be a harder decision for some who have already accumulated a lot to make, but potentially not. And I'll just tell you, I'm in the process of exploring all of that myself right now. Jeff Go asked, what's the range of interest rates that you have seen on the line of credit? I'll share what I've seen, Laura, and then you can share what you've seen. But right now, what I'm seeing is on your personal residence, they're coming out with around 3%, locking that in for 3 to 5 years. Some of them are going to be higher. On the commercial side with rental properties, I've seen them putting in, it's like prime plus 0, but they're putting in a floor because prime is so low right now. I've seen that the floor that I was just optioned was at 4% with no points. And I don't know how long they were locking that in for. But if prime were to go above 4, then my rate would go up. I don't see that happening anytime soon, but I think it's tied to prime. So whenever prime would go above 4 is when that rate would go up.
Mm-hmm.
But that's on the commercial side is at 4%. What have you been seeing, Laura?
So I'm going to first also talk about something else that we've done because we're in a low interest rate environment. rates are really good right now. And one of the other ways that we've improved our cash flow is we refinanced all of our rental properties, and we were able to get 3.5% at a 5-year balloon amortized over 25 years. So I literally stretched some of my properties out longer than however many years they used to have remaining, only because more cash gave me more peace. And at 3.5%, I was comfortable with that. We've also refinanced our primary residence and our cottage, and we did those at 30-year fully amortized loans, so a 30-year fixed rate mortgage. We got 2.73% on those loans. So this home equity line of credit that we're doing is really a commercial loan. We're not using our primary residence because I wanted to use our primary residence for that really low rate of 2.73. And the rate that we're paying on our line of credit is 4.25%, and it's tied to prime. So 4.25 must be my floor. And I believe we are actually, our margin is 1% above prime. So as Steve mentioned, as prime increases, I could see that interest rate increasing. But because rates were so good right now, I locked as many of my properties into longer term rates as what I could.
All right, so I missed one of the comments here. Jennifer said she missed the first few minutes. She doesn't understand how this reduces your debt. Do you want to answer that one or comment on it?
Sure, I'll comment on it. So the way that we've been able to use this to reduce our debt is basically the efficiency of using money that's coming in, because we have rents that are coming in every month and I only have to pay my property taxes. I actually pay my property taxes semi-annually, but when rents start coming in early in the year, instead of earmarking some money to pay my property taxes when they come due and have it sitting in a savings account earning little to nothing, I have it driving down the balance of my loan. Same thing for my homeowner's insurance. I happen to pay our homeowner's insurance on our rental properties quarterly. So instead of the money sitting in a savings account, again, earning little to nothing, I am making those payments to reduce the balance on my line of credit. So I have a lower balance. And then when it comes time to make those payments, if I don't have sufficient money in my checking account, I'm just taking an advance from my line of credit to do so. So instead of my money sitting there not really doing anything, I think I'm using my money more efficiently.
I love how you use that word efficiently, because even as your rent checks are coming in, typically you're going to be bringing in a lot of rent checks, tens of thousands of dollars a month that come in, and then that money sits there all month waiting for you to make the payments. In this particular case, it is going against the line of credit. It is reducing the amount of interest that you have to pay on that particular property. And it might only be for 25 days that it sits there before you're pulling it back out to make the payments. But 25 days of reduced interest is where the acceleration and the velocity comes from in paying down that debt. If you cut your interest payments by 20% for that month, you just that's all goes to principal, and it's a direct, pay down, and so that is it's the strategy that is used to pay down debt. Instead of having your money sitting there idle, it is continuously working for you. So you can think of it this way: if the interest rate on the line of credit is 4%, and you are saving money in an account to pay your taxes, to pay for health savings things, to pay for insurance on your homes, whatever it might be, if you're just letting it sit there, it's making you nothing. But when it's against the line of credit, you can look at it as it's actually making you 4% while it's sitting there, because it's reducing what you have to pay for, even if it's for a short period of time. So Jennifer got it there. So and we'll continue to try to keep bringing some clarity to it as we discuss it further. So Jeff was the one who asked about the interest rate range, but he also asked, can the lender call the loan due after 12 or 24 months? And Jeff, that really just depends upon the term of the lender. However, most commercial loans, whether it is a loan or a line of credit, have stipulations in them that they can call due at any time. And that is, you almost have to go based off of the track record of the bank, but I would be surprised if any of the commercial loans that you currently have don't give the banks the right to be able to just call those due at any time.
And actually, I'm going to comment on that. We have been in the rental business for a very long time. And a long time ago, one of the lenders that we had used, it was the lender that we had placed most of our rental properties with. They got into trouble. The lender got into trouble. We didn't get into trouble, but basically the examiners came in and called all of our loans due. So
of course, that's back in the 08 time period. Well, a lot of things were upside down, and what other lender was going to take something that was already upside down?
mm-hmm. So there's the potential that can happen. But I also think it's really important to have lots of lenders. You don't want to put all of your eggs in one basket. Have lots of lenders, and again, work on those relationships with the lenders. Stay in contact with them. Maybe give them updated financial statements to see how your business is doing and things like that. I always like to give my lenders things before they ask for things.
See, Joanne asked, would you do this on a property which you owe no money? Now, Joanne, I am going to say yes, but even if it wasn't for this strategy, and here's a couple of reasons that I put a line of credit on everything that I own free and clear, is because it provides me with liability protection. When you own a property free and clear, you can become a target for lawsuits, and attorneys love it when people own properties free and clear. But if you have a line of credit against that property, and for argument's sake, let's just say you have I'm going to use a round number, $100,000 property that you own free and clear, and the bank gives you a $75,000 or $80,000 line of credit. What's going to show up when somebody does a title search on that property is that you owe $75,000 or $80,000, whichever, let's just say 80. You owe $80,000 on that property. The balance on your line of credit might be zero, but the general public doesn't know that. And an attorney who might be out there looking for somebody with a lot of equity, or they're trying to decide whether or not they come after you, is deterred by seeing that you have a lot of debt. It appears that you have $80,000 of debt on your property. So as a liability, something to protect me, liability protection, I put lines of credit on my properties. In the event that somebody were ever to come after me, or I needed money quickly, all I have to do is write a check or make a phone call to the bank and transfer $80,000 in cash into my account, and I have access to that money immediately. So, if you own a free and clear property, but you're cash poor, that property doesn't help you out when you need cash quickly. And having the line of credit allows you to get cash very quickly and put it to work in other ways. So, would you add anything to that, Laura, or have any other thoughts about it?
No, I think that was good.
So now, I would also just suggest this, Joanne, that if you did put that line of credit against the free and clear property and you have other debts, you can now use that line of credit to pay off some of those other debts. Maybe you got a car, maybe you have some credit cards, and you can just pay them off with that line of credit and then strategically use this to pay off that debt as quickly as you can. So it opens up options for you for many other things by doing so. Brad McBee commented that interest rates are interesting, but the beauty of this strategy is rapid debt reduction, and that is the key. It helps you to pay down debt very quickly. Hussein said he's seen very similar to what I shared as far as interest rates are concerned. His rentals are low 4s and they're tied to prime, and has a mid 3% on his home equity line of credit. Is there a minimum equity threshold to start this, assuming you need at least 20+% on a primary residence? Gary's asking that question. You know, Gary, I think it's going to be different with different banks. And I have seen, without a doubt, when it comes to your personal residence, I have seen home equity lines where they're willing to go up to 90%. I would imagine if you searched long and hard, you might maybe find somebody who might do a little bit more than that. But 90% is not uncommon. 80% is going to be the most common thing that you will find as far as a line of credit against your personal residence. But because it's your personal owner occupied, I think that you'll find some that might just go a little more. Any thoughts on that, Laura?
I do have thoughts on that. I am super rate sensitive. So I have always been able to borrow 80% of the appraised value without paying private mortgage insurance. And that's not an expense that I'm willing to incur because we get no benefit from private mortgage insurance that we would have to pay that premium to insure the lender. So I always make sure that our loan amounts stay under that 80% value.
All right, we have Michael who is asking this question. Do we have an illustration of how debt on a house gets paid down faster using the home equity line of credit, velocity banking versus just paying the mortgage payments? An example, 5 years loan balance paid down to 100,000 versus 75. He's looking for a side-by-side comparison.
Mhm.
And I'll let you address it first and then I can chime in.
Okay. When I initially researched velocity banking a couple of years ago, there are actually calculators. There's a lot of information on the internet that you'll find about velocity banking. And there are calculators that can give you side-by-side comparisons. So I spent some time researching that years ago when I decided to set up something for velocity banking. Really, the point is you need to make sure that you stay disciplined and that you're not using that available credit for expenditures that you wouldn't otherwise use. And I know that the math works out fine if you are only taking money out of your line of credit for your expenses that you had previously. But if all of a sudden you let your monthly expenses creep because you have this availability, it's not a good solution for you.
I agree. And so on that note, there's a lot of variables, Michael, which is why it's hard to do the side by side, but I love the idea of the calculator and going ahead and just plugging in your own scenario. It really, the how quickly you pay things down depends on how much money you're putting against it each and every month. And, a higher income person is going to pay things down a lot faster. But the reality of the situation, if all things being equal and you just sit there and you make your mortgage payments and keep your money in a savings account, your excess money in a savings account, takes you 30 years to pay off your house. If you use this home equity line of credit, instead of keeping your money in the savings account and put it against the house instead, you'll, doing the same thing, can pay off your house in sometimes 5 to 7 years. And so it is a significant savings to be able to do that rather than having your money sitting on the sidelines in a savings account.
Can I ask a follow-up question to that?
Sure.
So I have a low interest rate mortgage. If I were to just pay an extra $500 a month on that, paying it down, which actually I was doing for a while, versus doing a HELOC, is the HELOC still going to be faster, maybe because it's not amortized the same way a mortgage is, or would it actually be even, the two scenarios at that point?
So, Michael, the first question I would ask is, once you look at your mortgage, there are mortgages that are amortized mortgages, and there are mortgages that are simple interest mortgages. And I happen to work at a credit union. So a lot of the mortgages today are simple interest, meaning you only pay interest for the number of days that you have that balance outstanding.
Okay,
Whereas previously there used to be a lot of mortgages that were called amortized loans. So if I made my payment on the 1st or the 9th of the month, so long as I was never late, my interest amount was always the same. So if you happen to have an amortized mortgage, which I think is probably less likely, you will definitely see a benefit in velocity banking because you can switch to simple interest, meaning you're only paying interest for the number of days that you have that balance outstanding. So it's really important to examine the mortgage that you have.
that is a really helpful tip. Thank you. I'm gonna look into that.
I want to encourage everyone who does have questions. Let's keep this discussion going inside of the app. Come on in and ask your questions. We've had someone ask, can we share the links to the videos inside of the app? And Deanne, if you can go in the app and actually ask that question, maybe tag Steve and Laura in that, we can keep that discussion going. I do want to point out for those of you who are not aware that, you know, Steve and Laura, they came into Lifeonaire 5 or 6 years ago. Today, they are coaches and they are just helping people, coming alongside of them and coaching them with Lifeonaire and just making a difference in people's lives. And so, you know, they just have a heart for helping. So I want to encourage you, if you do have questions, feel free, just ask them questions and put your questions in the app, and then we can all benefit from it over there. Vinny is giving you a whoop whoop. So Brad made the comment that the trouble is finding a lender that will do a first position line of credit. And for most people, it's easier to get a HELOC as a second and then just make lump sum payments to your first. I don't know that I agree with that, Brad. It's just not the typical thing that people get. And so, I mean, literally, I just walked into a local bank here now and was putting a line of credit on my personal residence. And I mean, he said, you want it as a first mortgage? And I said, yes. And he said, you don't have a first mortgage and you're not looking for just like a home equity? I said, no, I want this to be my first mortgage. He said, oh, okay, I guess we can do that. I've never done that before, but we can do that. And so it was really just a matter of, I think all too often, it's not that they don't do it, they're just not used to doing it. And it's just a conversation they're not having. There really is no difference between them doing it as your first mortgage. It puts them in a better position than being a second. So,
and actually, Steve, I'd just like to comment on that. One of the things that I think is valuable, I negotiate a lot with my lenders on interest rates. And
Is that what you call that?
yes. So I think that's actually an important point, that you are in first position, you have less risk than if this were in second position. And just so everybody understands really what that first position versus second position means, it's just who is entitled to foreclose on the property first if you wouldn't make good on your promises. So if you have a home equity line of credit that's in second position, it means that there's a lender sitting there in front of that has first priority if something doesn't go good for you. So I've always used that to negotiate better rates, that you're going to be in first position.
so yeah, I have had a number of them just look at me like I was crazy when I asked them for that the first time, and then it just took a little bit of explaining, and they have come around every time. So, well, I want to just again encourage everyone that this is a strategy that I would expect that as we're getting ready to wrap this call up, that many of you probably have more questions than things answered. And I would encourage you to bring those questions into the app. It really is not that complicated. It is really a rather simple process. It has all the benefits that Laura has shared. I've experienced every one of those benefits, from rapid debt payment, pay down, to having access to cash, to reduction in stress. It really, when you employ it and you use it, again, it's a strategy, but if you don't utilize it the right way, you're better off just having a 30-year mortgage. If you know the higher interest rate, if you're just going, if your mortgage payment on your 30-year AM mortgage is $1,200 a month, and then you switch over to this with a higher interest rate, and you're just going to pay $1,200 a month against it, you're making a mistake. The whole idea behind this is taking everything you have and putting it against the line of credit to reduce your interest for that month, and to put anything additional toward your principal pay down, and it begins to pay down very quickly. And so someone just said, I don't understand what you mean when you say bring the questions into the app. There's the Lifeonaire app, the Lifeonaire forum, the community. Go in, post your questions inside of the Lifeonaire community, and then we can continue the discussion there. And so if you don't have it, you can download Lifeonaire app on your phone. You can also just go to lifeonaire.com and join the community through there, so you can access it from your desktop. But it's a great place where, and Renee, you've been in there, so I've seen you in the app, and just post your questions in there, and we can keep this discussion going. And then finally, next month we will talk about something that's similar but different. We'll be talking about infinite banking and seeing if that's a strategy that's worth considering for some of you. Infinite banking is going to be more along the lines of savings and becoming your own bank, not necessarily the same kind of strategy for paying down debt, but for accumulating savings and becoming your own bank. And you can actually modify both of these and do similar things with them, but they have different pros, different cons, and we'll go over what some of those are next month. Steve and Laura, anything else that two of you would like to add?
I don't know if it'd be possible, but I wonder if there'd be such a thing as having a group call with everybody's lenders. Get everybody, everyone bring in their number one lender and have this type of conversation with them. And maybe, globally we could create something that works, across the board for everyone. I don't know if anybody'd be up for that. Anybody as in the lenders, if they'd be up for that, but it'd be an interesting topic.
I think it would be an interesting topic and a cool call just to hear all of their different takes, but I feel like it would be hard to pull together and coordinate, but who knows? We'll see. You have anything, Laura?
I think there are lots of different strategies out there for working on reducing your debt, simplifying your life so that you can have a better lifestyle. So employ all of them.
I agree. And this is one of the most powerful ones. It gives you a lot of control. And so this is why it was exciting to bring this one to the community. I hope that you are blessed by today's, presentation, and I'm grateful, Laura and Steve, for the two of you coming and sharing this with the community. And hopefully, if there's anything else that we need or any other questions that you have, that we can keep this conversation going. Let's bring it into the app. And as you're taking these steps, any stumbling blocks or anything that you have along the way, just simply ask us, and we'll do everything we can to help you and lead you in the right direction. All right, everyone, we're coming to the end of our call here, but hopefully we'll see you soon. And again, we've got some people saying see you at the summit. I'm looking forward to seeing as many of you there as we can possibly see. Have a great day. Take care.
Bye. Thank you.